The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Hi there, welcome one and all to another live webinar with us from Phillip. And here what are we going to be talking about today? We're going to be talking about discovering opportunities in the soybean market. And this is your facilitator of the day. My name is Sri. And if you've joined us in our earlier webinars, you would have heard from me and also from our keynote speaker for today. He's none other than proprietary trader David Ng, who's been featured in several of our commodities webinars in the recent months. And what will David be sharing with us today? He'll be talking about opportunities in the soybean market, of course, and he will be walking us through the opportunities by discussing the fundamentals of the soybean market. He will also touch on a key point, which is how the economic recession could impact soybean prices and the correlation between soybean and palm oil prices. David will also share how you can capture opportunities in the soybean market using technical analysis. Before we begin, can I just do a quick sound check to see if you can hear me loud and clear? If you can, please go on to the question box and type yes if you can hear me clearly. All right, thank you, Li Ting, Eric Go, and Teck Chow. Thanks for confirming that you can hear me loud and clear. David, if you're all set to go on your end, I can hand the reins over to you now, David.
Yeah, hi. Thank you, Sri. Just a quick check. Sri, can you hear me loud and clear?
Loud and clear, David.
Okay, can you see my slide as well?
Yes, I can.
Okay, that's good. Okay, I'm ready to go.
All right, go for it, David. Walk us through the opportunities in the soybean market.
Okay, firstly, just like to thank Phillip, Noah, as well as CME Group for inviting me to speak on today's topic, entitled Discovering Opportunities in the Soybean Market. So for those who probably have, traded the commodities market, you have probably witnessed a significant volatile market for at least the first half of this year. So really it was a challenging period, especially in the beginning of this year, with the ongoing Ukraine and Russia conflict. I think it's going to create a lot of impact in the commodity space. So as usual, before I start, risk disclaimer. I think any materials presented here is purely for educational purpose, and any opinions are purely my own. It doesn't reflect any opinion by Phillip or by the exchange itself. And I think dealing with derivatives does involve risk, so make sure you do consult your licensed representative before you embark on your trading journey. Now, so as what Sri just highlighted earlier, I think some of the key things that we're probably going to discuss in this webinar session is we're mainly going to talk about the fundamental dynamics, especially when it comes to trading the soybean market. Well, obviously you can know soybean, when you trade the grains market, they are all quite interrelated. So if you trade fundamentals, if you assess the fundamental dynamics of soybean, it does have a bit of resemblance whenever you look at the corn market. So soybean and corn are two very important commodity products when it comes to the CME grains. So for those who are trading the grains market, soybean and corn is a very popular product to begin with. Then last one, I think on the second part is we pretty much will touch on how the impact of the global slowdown as well you're witnessing, and some of the key decisions by central banks will have an impact especially in the commodity space, and in this regard it will have an impact with soybean prices as well. Now, if you have been trading soybean and one of the key product or key byproduct is the soybean oil market, probably have seen there's a lot of relationship between the palm oil and soybean oil lately. So you're in Malaysia, palm oil is a very popular product among the trading community. So whenever you look at palm oil as an example, normally we will put reference to soybean oil as well. So later part we're going to see how this relationship actually plays out, and how we're going to see that whether what kind of relationship that we can probably base on when it comes to trading decisions. Last but not least, I think towards the end, we're going to touch a little bit on technical strategies that we can use. Now, I like to keep it simple, when it comes to creating a trading plan, because once it gets very complicated, you tend to have a lot of confusion when it comes to entry and exit positions. So it's important whenever you create a trading plan to keep it simple. So later on, I'm just going to detail some of the keys, simple steps that you can use. whenever you want to start your trading journey, especially in the grains market. So I'm just going to start off with just looking at the outlook for pretty much the commodity space. So if you have probably followed the market, you have tracked the market, this year we have seen tremendous rally across all commodity space, leading by crude oil, which hit a bottom back in during the early part of pandemic. First time we've seen negative prices, and we've seen significant rally thereafter. So really, it's not only confined to crude oil. We see a significant rally in a lot of major other commodities, especially in grains. So look at soybean prices. We used to trade around $8 per bushel. Now we are looking at about as high as $16. That's almost 100% increase in terms of their price trajectory. Now it's not only soybean as well. If you look at corn, we have been trading the $3.50 for pretty long time, and it actually finally broke that $4 range and it hit up to at least as high as $8. So really, I think commodity in general has really seen a significant rally, and all these are partly attributed to, first thing was a logistical issue due to the COVID, and I think secondly, it got aggravated by the Ukraine and Russia conflict, which is it seems to be quite serious in the beginning, and it continued to escalate, and it caused a lot of havoc, especially in the commodity market. Now, when it comes to global growth, I think important, as long as global economy is growing, there's always a demand for commodities. We're always very concerned, especially when global economy is not moving as fast as it is. So really, you just look at some of the projections you are seeing, especially for the next half of this year and into the first quarter next year. I think a lot of central bodies around the world are projecting that the economy is going to slow down. So with that in mind, I think really, commodity may face a lot of headwinds, especially going to the third and fourth quarter. And obviously, this is all propagated by, China being a very large consumer, and it is slowing down in certain areas. Now, I think this year, a lot of traders was actually looking at, investors as a fact, is really looking at the year of recovery, especially when a lot of major countries are actually moving out of lockdowns, and really they're hoping that commodities will finally see a rally. And true enough, I think commodity rallied, but the Ukraine and Russia conflict really aggravated the situation further. So I think this year is not only a theme of recovery, also a theme of high prices, and therefore I think inflation was a major concern, especially for first half of this year. So if you just look at the food agriculture prices, you can clearly see that, at least for the first 3 months of this year, food inflation was hitting tremendous levels, and it actually got a concern, pretty much a global concern. In fact, I think a lot of countries have started to face severe inflation when it comes to food prices. But thereafter, I think just a couple of months back, especially starting in June, where we start to see easing of some of this logistical backlog. Even in fact, Ukraine has actually offloaded some of the major commodities, especially with the wheat crop. And I think that helped to ease some of these backlogs. And therefore, I think prices of these commodities actually retreated. And I think recently also we've seen rising odds of recession that's happening. I think therefore, a lot of countries are actually feeling the impact. And therefore, I think commodity prices are pretty much reflected that as well. So really, I think what explains why commodity prices has actually retreated from the highs as we've seen back in early March this year, I think it's mainly down to the easing of logistical issues, especially with Ukraine, as well as I think the fear of economies sinking into possible recession, especially in the second half of this year, is really pulling down the commodity prices. So the key question we should ask ourselves is, since commodity prices has retreated and inflation was a major concern this year, as what you have seen in the US print yesterday, CPI numbers was actually way below than expected. So is this a possible peak in inflation? Now, I think that's inflation is still quite stubborn in certain areas. When it comes to food prices, although we are seeing a bit of retrenchment in certain commodities, especially with corn, or even in fact to a certain extent soybean as well. But I think that stubbornness will still continue to persist at least for a couple of months. So inflation will still remain quite sticky. I still believe it's still quite elevated at this point in time. and it will continue to be so at least for a couple of months before we start to see really supply coming in and really will push down prices. But as for now, I think inflation will still be a major concern for pretty much central banks around the world. Now, so just to reiterate the point again, I think global inflation is obviously a cause of concern for this year, given the fact that we've seen a lot of commodity hitting all-time high. But then again, I think if just a couple months back, given the 1.5 months earlier, we have seen a lot of major commodity prices actually retrace back to at least 50% of its level. And I think this really helped to ease a bit of inflation fears. But whether is this going to be trend going to continue, it seems to be unlikely, given that a lot of some of these major commodities, especially corn or even in fact soybean, although we are seeing supplies coming in, but I think demand is still pretty strong, given the fact that economy is actually slowing down. So now when you trade grains market, if you assess the grains in terms of the fundamental aspect, there's a lot of factors to look at. Obviously, this list is not exhaustive. There's always other external factors that could always change or always move prices. But there's always a key fundamental aspect that one must always look at whenever you're trading a grains market, which is the demand and supply. So whenever you have a market where you have a high demand and low supply, generally you will see higher prices. And vice versa, if you look at a market which is oversupplied and low demand, generally look at prices tend to trade on the downside. Now, one thing great about trading commodities is that every commodity will be very different. If you trade corn and soybean, although they share quite a similar resemblance, but when it comes to prices, they are actually quite different. In fact, certain commodities they tend to display seasonality patterns. So say for example soybean, there's always a seasonal pattern. Around June or July to October period is where prices tend to be weaker. So during this time as a trader, based on historical pattern, if you note that during this time you should be avoiding taking long positions because these are the weaker periods based on historical basis. Now, if you trade grains, it's important for us to take note on certain reports. I know trading commodities can be quite tedious, but we have to be quite sensitive to this report release because markets will take a move for sure. So I think reports by USDA are important to look at and gauge because USDA do come out with certain important reports monthly basis and on weekly basis. And if you're trading soybean, normally you need to take note on the weekly crop planting progress because now we are entering into planting season in US. So any change in weather that affect the quality of the crop will definitely have impact on prices. So I think that's one thing that we need to take note, especially if you are trading the grains market. Now, of course, we also have to assess substitutes. Like if you're trading soybean oil, you need to assess palm oil and vice versa. If you're trading soybean, we also need to look at corn. And obviously, if you trade these three particular products, I think one of the major commodity that's actually giving a lot of impact into other substitutes is obviously crude oil. So whenever you have a strong crude oil market, normally is in favor for corn and soybean as well. Later on, we're just going to see some slides which actually we can look at and we can see the relationship between crude oil and other commodity markets. So crude oil remains a very important dynamic, especially when it comes to trading grains, because the relevance of biofuel, using blending crude oil with other oil minerals are something that is getting quite prominent, given that US is also going into green energy. So I think these are all the dynamics that we have to be aware of, especially when trading a grains market. Now, geopolitics and weather extremities are another factor that's also very critical. When it comes to trading a US soybean market, US and China is always a geopolitical tension, which is making traders quite tense in certain ways. Any news that's coming out from US and China will always disrupt prices in the commodity space. So geopolitics is always a major concern. Now, I'm not sure whether it's the effect of global warming or not, but weather has been getting very volatile lately. We have seen a lot of heat especially in US area. I think that's why it explains why soybean market has actually been seeing a bit of rally in the past couple of weeks. So I think weather is always a major play when it comes to commodity, be it whether you're trading corn or soybean. Weather is always a major factor. Now, I thought I'll start off with, for those who are new to the grains market, just to give you a bit of a sense of, when are the periods where a particular harvesting or planting season starts. So in US, corn and soybean are usually planted at least the second quarter of the year, starting from April to June, and those harvests are usually harvested around September to November period. Now, if you look at Brazil, which is also a very big producer for soybean, in fact, it's the largest producer for soybean in the world. Their planting and harvesting season is the opposite because of the position in the hemisphere. So their planting season starts in the year end, and harvesting starts early first quarter of the year. So if you look at it, I think US and South American supplies are pretty consistent. Keeping in mind, China is a very large consumer. If they can't, when US go into planting season, they can't afford to have no supplies of soybean in the market. So that's where Brazil and Argentina could come into the market and fulfill those demands. So in a way, consumers like China or India who needs constant supply of soybean, I think US and South American supplies can play a big role in ensuring that there's always continuous supply in the open market. Now, so again, I think USDA reports are very important if you are someone that's trading a grains market. Now, there's normally two ways to look at it. If you are someone that's looking for volatility in the market, obviously you'll be looking at when is the USDA release reports days, because at those days you get to see big price action. But then again, prices tend to move very volatile. So if you are someone that couldn't take that kind of volatility, it's best to avoid those report release days. So it really depends on individual. But then again, I think the market will always pay close attention to any USDA reports, whether it's on a monthly basis or whether it's on a weekly basis. So going into the dynamics of it, I think the first thing is always to assess the fundamentals of a particular commodity by looking at demand and supply. So judging from supply basis, really, I think this year, given weather is assuming to be normal, the pattern doesn't seem to show any extremities. I think US is looking at probably a bumper harvest. Corn slightly on the downside. I think that's because the yields are also projected to be lower due to the heat that is facing in some of the key growing areas in US. Now, I think just a couple of days back, when we look at the crop planting progress for soybean, I think that also take a toll. I think certain key soybean areas are also facing a bit of heat issues. So really, I think weather is a major play, especially when it comes to sensitive periods like especially during the planting season for US. Now, crop conditions or crop planting progress, which is released on every Monday on weekly basis, is a report that I think a lot of traders will always look at, especially during the crucial months like this. Reason being is because any sign that crops are getting the progress of crops are deteriorating, I think that usually tells you that prices will have to go higher to adjust on that downside in terms of production. Now, vice versa, if planting progress are looking good, normally prices will tend to adjust on the downside. Now, what we have here is that if you just look at soybean itself, the soybean conditions for good and excellent crops, they actually went down by 1 percentage point just this week alone. Therefore, I think it explains why soybean jumped almost close to 3% on Monday. So really, that explains why crop progress is an important report to gauge on a weekly basis. Now, it's not only restricted to only soybean. If you just look at corn conditions as well, if you compare to its 5 years average, I think this year it looks like it's quite a bad year in terms of production. I think it's all really boils down to weather. There's a lot of weather reports, especially in US Midwest. It's been reported that the weather tends to have a bit of drought. So I think therefore it's actually impacting you. So going forward, as we head into the middle of this month, or in fact towards the end of this month, it's crucial to watch whether crop planting progress is getting any better. If it's not getting any better, I think that's going to be an issue. And really, I think that's going to have an impact on prices. So really, you just look at this year crop ratings just for soybean itself. Just this week alone, we just recorded a 1 percentage point decrease in crop rating, and therefore I think that explains why prices move as high as 3% once the report is released. So going forward, I think as long as weather issues are in play, I think that's where we get to see, prices tend to be supported during this point of time. Now, obviously, we have also a monthly report, which USDA always cover. And in this USDA monthly report, it always shows that the projected yield for corn and soybean. Now, when USDA project a higher yield, whether it's for soybean and corn, normally prices will have to adjust. But in this case, I think, and whenever USDA projected a lower yield or lower output than expected, normally prices will tend to react quite positively. Now, if you just look at what its estimates are before the official release this Friday, I think really, USDA is projecting the soybean yield as well as corn to actually yield lower. Now, if you just look at crop ratings earlier on, which on the previous slide, you can clearly see that ratings of corn and soybean crop has not been good. Over the past couple of weeks, we have seen deteriorating conditions in certain fields. So therefore, I think it's fair that USDA is actually projecting lower yield. So if the actual report came out to be lower than expected, we probably could see some price reaction. So if you are trading the market, do watch out. I think this Friday USDA report will be quite crucial when it comes to determining what is the yield like for soybean and corn market. Now, when it comes to weather, it is something that is unpredictable. It's a very important factor, as we know, because if you are trading a commodity space, weather is something that it can happen on a single day basis, and it can be quite persistent. So normally, if weather patterns is there to stay, you can expect your yield to be to be affected as well. So if you compare 2021 and 2022, just 1 year ago, you can clearly see that during the same time last year, you see a better weather conditions as compared to this year. I think this year across a lot of major key growing areas, whether it's soybean or corn, we are seeing very hot weather conditions. I think that's going to be affecting yield going forward. So again, I think all this will translate into your crop planting progress on a weekly basis. As long as crop ratings are not getting any better, I think that's going to spell out in terms of price action. So do watch out. I think all these reports is going to be closely watched, and it's going to be having an impact on prices. Now, so that's on the US supplies. If you just look at US itself, obviously US is no longer the largest producer. They used to be the largest producer in the world. US used to be number one until at least 2014 or 2015, where it got overtaken by Brazil. Now, Brazil, the South American supplies is usually very consistent. We don't see any, especially with Brazil, I think every year they are actually increasing their acreage, their planted acreage. So I think this year, assuming the weather is normal, I think Brazil is going to head for the biggest production. I think it's about 150 million metric tons. It's the biggest in history. Now that's assuming weather conditions are normal. But then again, there's also a report that certain parts of Brazil is also facing a bit of a heat. So I think therefore it's going to impact on their production. But then again, I think given the fact that acreage has increased, naturally total production will also increase. So really, I think Brazil is going to see a highest record of production this year. If you just look at the second biggest or second largest in the world, in the South American supplies is Argentina, and their supply is actually quite consistent. But then again, we don't see any incremental this year based on USDA report. So going forward, although we see a bit of upside in terms of US crop planting in terms of their progress, but keep in mind, South American supplies are coming into the market, and with Brazil having the largest production or expected to have the largest production in history, it's definitely going to be pressuring the market. So I think one key indication to really identify whether a particular commodity is having a bit of support is always look at the stocks levels. As long as the stock levels are low, that tells you that generally the price will tend to be supported. So if you just look at ending stocks, whether it's US soybean and corn, especially for soybean itself, you can clearly see Last year we saw very low stock levels. Therefore, I think price is justifiable to be trading at about $18. But then again, I think that softened back to about 14 to 13 US dollar. And if you just look at USDA ending stock projection, they are looking at stock levels to increase in coming months. Now, there's two factors to it. One is, keep in mind, South American supplies are coming in, and second thing, I think demand destruction is we start to feel the effect of demand destruction, especially coming from China, which is such a big consumer. If they slow down in terms of the economy, I think that will have an impact. So I think it's a variable that we have to watch out closely as well. Ending stocks is as long as you have high ending stocks, generally the prices cannot go any higher. So that's where we really need to pay attention to in this regard. Now, again, I think just to reiterate the point, stock levels are expected to increase. So I think therefore the stock to usage ratio. Now, the way to interpret this is simple. If you just look at the stock to usage ratio, if you have a low stock to usage ratio, that means that a particular commodity is very tight. So therefore, prices will tend to be will tend to go up. But when you have a high stock to usage ratio, relatively speaking, I think that would tells you that generally the prices will tend to be on the low side because you have a high stock level. Now I think USDA is probably expecting that stock to usage ratio is going to go higher in the coming months, given the fact that stock levels are actually expected to increase, given the sluggish demand as well as higher production. Now, Brazil, given the fact that they are recording the highest production this year, so therefore they have to export as fast as they can, and their biggest customer is always China. So as long as China still demands soybean, Brazil will be the first one to always will always be there in the market to supply those beans. Now Argentina is slightly different, although they are quite a big producer for soybean. When it comes to exports, they're actually quite not quite sluggish in a sense. Now I think that's attributed recently. If you just look at the news, I think Argentina currencies are actually weakened substantially. So a lot of farmers in Argentina decided not to actually put their exports out. So therefore, I think Argentina exports are still quite not sluggish at the moment. But then again, stock levels in Argentina are actually climbing. So that tells you that those farmers eventually will have to sell their beans. Whether it's at a loss, they have no choice because beans are perishable. You can't keep for long. So eventually they have to push out to the market. So all in all, I think South American supplies this year is going to be higher, and that's going to be a concern that's going to pressure prices as we head into the next coming months. So even though we see strong Brazil exports, if you compare year-to-year basis, I think this year basis looks like even though we started off the year quite strong, but it got tapered off, especially towards the April and May period. This is in line with some of the key city lockdowns in China. Again, this all depending on China. If China is slowing down, you really can feel the impact when it comes to exports, soybean exports. So it's very evident, especially when during the major city lockdowns in China back in early April, early May, we can clearly see their demand for soybean has actually slowed down substantially. So now China is the reason I talk about China is because when it comes to grains market, whether it's you talk about corn or soybean, we have to look at China because China is a very big consumer. And you just look at the progress of China's soybean in terms of their usage, domestic usage is tremendous. This is in line also with a growing economy, with growing middle income. The demand for soybean has actually increased substantially over the years. So imagine back in early 90s, China was actually quite a net exporter of soybean. They do in fact produce soybean, but domestically those days they don't need that much of soybean. But that scenario has changed back in the early 2000s. So really, I think the scenario that we are looking at is China will continue to demand soybean. But what is critical is that as long as the economy is growing, and if they continue to be maintaining the zero COVID policy, I think that's going to have an impact. So China is quite a wild card. So if we just look at it, we should expect China demand for soybean this year to pick up substantially. Reason being is because if you just look at some of the statistics, it shows that they have low stocks, and if you just look at some of the economic numbers, they're actually showing you quite robust growth. But then again, I think with zero COVID policy, I think that's going to have an impact. And it's quite evident in some of the key export statistics. So really, I think China, if you want to look at demand, just look at China. And China, because China is a very big player in the market. So again, I think I'm not going to go too much on China's economy. And I think the main thing is that as long as China maintain a zero COVID policy, it's going to have a big impact. When major cities are under lockdown, there's a lot of restriction that's going on, and therefore I think that's going to hurt soybean demand. Now, so I think just to show you why Argentina has been quite bad this year in terms of their exporting of soybean. I think that's again because of their currency, and this is always a persistent issue. As long as their currency weakens a lot, farmers in Argentina, they have no incentive for them to export. So therefore, they choose to just keep their harvest at silos. But when those silos are full, that's where they're going to face a big issue. And that's what we are seeing right now. So Argentina, a lot of Argentina farmers are facing issues of storing their harvest. In fact, I think just give them a couple of weeks, they probably will be quite desperate to sell their produce before they go bad. So I think that's where, again, I think when it comes to supply, this is why we don't see much of supply coming from South America, especially from Argentina this year. But keep in mind, I think Brazil is trying to fulfill that gap because Brazil is having the largest historical production in history. So that's pretty much on the fundamental of supply and demand dynamics. Now, when you trade grains market, especially when you trade the futures product, it's important for us to look at what we call net positions in the market. So if you trade the CME group exchange products, you notice that every weekly basis we have report on published by CFTC to show you what is the net positions that's open in the market. So obviously we have traders can always take long or short positions in the market and hold it overnight. Now, it's a simple way to look at this is that whenever you have a net positive positions in the market, it tells you that generally the market participants are quite bullish with the overall sentiment in the market. Now, when that changes, when let's say when the market changes from net positive to net negative, that shows you that the market sentiments actually change from bullish to bearish scenario. So what you can see right now is that in both corn and soybean market, we see that the net positions are still positive, but it has been declining since back in early April, and that was in line in where prices actually hit an all-time high and started to decline thereafter. So really, I think it's a good gauge if we just want to understand what's the sentiment in the market at this point in time. It's good to get a gauge from the net positions that is available on CFTC data. So really, I think you just look at soybean and corn. Currently, I think we're looking at net positions to start to decline slightly because I think generally I think sentiments are still slightly on a bearish end. But keep in mind, things can change. So once net position starts to go higher, that usually indicates that the sentiments still remain quite positive. So that's how you should position your view in the market. So just to show you the effect of a report release, again, I think just to put up the point, if you are someone that loves volatility in the market, report release days are usually watch at or closely watch at because prices move quite volatile in those days. Now, just taken for example for this is the last month's USDA monthly report. You notice that I think the report came out bearish, that more bearish than expected. You can clearly see that the prices adjusted at least 8% on the downside. So this coming Friday will be the August monthly report. Again, do watch out if you are someone that is you don't like volatility in the market. Avoid trading those days because market can get a bit more volatile in those periods. So these are the list of dates for the upcoming USDA monthly reports, which we should be closely watching out for. Now, what I have here is that two different products. One is looking at crude oil WTI against the soybean. If you notice that both the products both the prices are actually trading quite in line. Whenever you have high oil price environment, normally it benefits soybean as well. So clearly you can see right now we have seen a decline in crude oil. It went as high as $120 per barrel. Now it's trading below the $100 mark. And same goes for soybean. It hit as high as $18 and now it's trading below below the $15 mark. So this tells you that I think both share a very close relationship. In fact, I think when you talk about commodities, normally we have to pay attention to crude oil because crude oil is pretty much the biggest contributor when it comes to commodities percentage. So really when you talk about commodities, we really have to look at crude oil element as well. So if you just break it off and you just take it as a one unit as itself, I think crude oil has its own fundamentals. The fundamentals, although looks slightly on the bearish end, but then again, as long as economy starts to recover and crude oil starts to head higher, I think that will also be bringing soybean along. So I think that's a relationship that we can look at, especially the crude oil and soybean relationship. Now, for those who are trading the palm oil, obviously you'll be very keen to looking at soybean oil relationship. Now, if you just look at the relationship between the soybean oil and palm oil spread, it's always trading at a premium. There's certain occasion whereby in history that the soybean oil and palm oil spread traded negatively, which means that soybean oil is cheaper compared to palm. But those instances will never last long. So if you just look at historically, I think just June last year or just last year itself, we saw the spread hit as high as $600 per metric ton. Now, whether the feed will repeat again this year, it looks like we are inching higher to the 600 mark, but I think that could be a major resistance. So really what this tells you is that, so I think soybean oil is way overpriced compared to palm at this point in time. There's a lot of factors to it. So one must understand, whenever we look at a soybean oil perspective, we have the US president policy on green energy, which is very supportive for the green energy segment. So that will continue to push soybean oil prices. But palm oil itself has a different fundamentals as of now. With Indonesia coming on strongly, aggressively trying to push out excess stocks in the market, I think that really depressed palm oil price. So therefore, that explains why the spread has actually been trading at around 500 to 600 level. Now, whether you are a trader that always look at extremities and trade on a mean reversion basis, whether this spread will mean revert, eventually it will mean revert. It's a matter of time. But really, I think this spread can stay at this level for a period of time until the fundamentals of each respective product changes. So I think do watch out if you're hoping that the spread eventually will narrow. I think that's usually the base case, but it's a matter of time on how long that this spread can stay as elevated as this level. Now, so moving on to the final part of this webinar, I think despite understanding all the dynamics of the fundamental dynamics of the market, it's important for us to also understand what are the simple strategies that we can use, especially when you want to enter and exit the market. Now, having a fundamental helps you in creating a view of the market. So as I mentioned, I think it's always good to have a certain basis of where the sentiment of the market is. As long as the fundamentals are bullish, and the technical trends are showing you bullish, and if you're a trend trader, ride with the trend. It's always a difficult proposition to always go against the market. So I think when it comes to strategies, technical strategy wise, is the first thing you need to do is to identify the trend, the major trend itself. There's always a lot of ways for you to do it. I think one of it is to have a visual depiction, whether usually visually you can clearly see from the chart, as long as prices are going high and making higher highs and higher lows, that tells you the market is generally going to be bullish. If the market is making lower highs and lower lows, that tells you the market is generally going to be bearish. And if it's a sideways market, the highs are usually quite consistent, the lows are usually quite consistent. That tells you it's a ranging market. Now, besides looking at it visually, I think to make it easier, I think what we can use is that we can use an exponential moving average and 200 days, in fact, 200 period. And if you plot that, if you plot prices against that, as long as prices are trading above or below, that can clearly tell you what is the trend like. Now, I'm just to share with the audience here, the strategies that I lay out here in this session is probably based on trend trading strategy. Obviously, if the market is range trading, then we need to be using a different strategy. So when it comes to trend trading, besides identifying whether the market is bullish and bearish, it's important for us to determine the strength of the trend. One way of doing it is to what we use an indicator, ADX indicator. It is very useful, especially when it comes to showing you the strength of a trend. Later on, we're just going to look at the slides. What are the key parameters to be using, especially when you look at ADX. Now, when it comes to entry and exit, I think Heiken Ashi candles are usually I usually use Heiken Ashi as compared to Japanese candlesticks, given the fact that Heiken Ashi is also a derivation of Japanese candlesticks, but it does depict the trend in a clearer manner as compared to the normal Japanese candlesticks. Later on, I'm just going to share with you why is that so. I think we can couple with that to make your entry and exit better is to couple with the exponential moving average crossovers, and with that I think it will make your entry and exit better in a sense that it will show you when the market is turning at a particular point in time. Last but not least, with every trading plan, we really need to have a risk management in place. Without proper risk management, you are just putting yourself too much of a risk or too much exposure to the market. So we can, I always like to use this indicator as a measurement of risk, which is the average true range, which I'm going to share on later in the slides. So I think first thing first, we need to identify the trend. So one way of doing it is to incorporate a 200 period EMA. So you can clearly see in this chart, the blue line is your 200 period EMA. As long as prices are trading above the 200 period EMA, that tells you the market generally is going to be bullish. If the market is trading below the 200 period EMA, that tells you the market generally is quite bearish. So if you just look at soybean, it actually entered into a bearish territory back in early July, and it continued to be there, to stay there. And in fact, I think the 200 period EMA is pretty much in line, the $15 mark. So right now, I think even the 200 period EMA is not only used as a way to determine whether a market is bullish or bearish, but it's also used as a resistance point. So right now, the market is trading below the 200 period EMA. That tells you the market generally is quite bearish. So again, let's look at whether the market can retest again the key resistance area, which is about $15. If it does break that, that usually tells you that the market will have some leg to go higher. Now, once we identify the trend, if you just look at the market itself, is trading below the 200 period EMA, is indicating to you that the market generally is quite bearish. The next thing we need to do is look at the strength of the trend. So even though we are looking at generally the market to be on the downside, the strength of the downside move tend to be weaker. If you just look at ADX indicator, it's showing you about 20 points. That tells you generally when it's 20 points, either the market has no range, or in fact the market is trading at a range, or the market has no trend at that point in time. So if you just look at it based on the ADX indicator, it tells you that I think soybean at this point in time is trading at a very tight range. So if you are waiting for a trend to be evident, wait for a breakout, whether it's on the upside or the downside. Or in fact, when ADX starts to hit higher than 20 points, that tells you actually the market is trending higher or lower. Now, again, I think if you just look at where soybean market is right now, I think the market is trading at a very tight range. If you just look at the average true range value for the soybean market, is trading about 70 points, and it's declining, in fact, on day-to-day basis. So that tells you, Jenny, I think the market is trading on a very tight range at this point in time. Normally, when the ATR value goes higher, it tells you that the market is actually breaking out of a particular range, and usually that's usually the point in time where the market starts to trend. Now, besides, after determining the major trend of the market, next we can do is that to determine your entry and exit, we can obviously use a Heikin-Ashi candles against the Japanese candlesticks. Now, if you just look at exhibit A and B, you can clearly see that, which is a better way of depicting a particular trend, price trend. If you just look at exhibit A, which is your normal Japanese candlesticks, you can clearly see there's gaps in the market. There's a lot of red and green bars side to side. So it's very difficult to pinpoint to you at that particular point in time whether the market is trending higher or lower. If you just look at exhibit B, it's still the same chart, same product, same time frame. But then again, it's using Heikin-Ashi. Now, Heikin-Ashi, there's a mathematical formula to derive. It's basically derived from Japanese candlesticks. The only thing is that it doesn't account gaps. If you just look compared to Japanese candlesticks, which is exhibit A, there's a lot of gaps in the chart. So if you're a gap trader, Heikin-Ashi may not be suitable for you because it actually close up the gaps and to show you a particular trend of the day. So you just look at Heikin-Ashi, it's very clear. Whenever the market is going up, there's very strong green candles. That tells you the market generally is quite bullish. Red candles, red bars, as long as those candle bars are getting wider and bigger, that tells you generally the market is actually going to hit on the downside. So it's very clear depiction of where the trend of the market is at that particular point in time. So it's just put into context. You can clearly see whenever you see series of red candles, that tells you generally the market is quite bearish. Vice versa, if you see a series of green candles, that generally tells you the market is actually quite bullish. Now, when it comes to, if you see a series of candles which is quite similar in length, and the colors are series of red and green, that generally tells you the market is actually trading in a range. And in those instances, if you are a trend trader, you really need to be careful, because when the market starts to go into a range market, if you're using a trend trading strategy, normally it will be quite difficult. So that's why we really need to be observant and be careful whenever we approach those markets. Now, Heikin-Ashi itself may not be sufficient. If you incorporate that with moving average crossovers, and here we are using two periods. One is a shorter period, one is a longer period, and it's defined by a 9-period EMA, which is a shorter period, and a 20-period EMA, which is a longer period. So crossovers are quite easy. Whenever the shorter term, the 9-period EMA crosses below the longer term 20-period EMA, that tells you generally the market is quite bearish. It's a bearish crossover. Vice versa, if the 9-period crossing above the longer period, that tells you generally the market is quite bullish. So the circle parts are generally where you can see a crossover is happening. And if you couple with that with Heikin-Ashi candles, so if you see a bearish crossover on your EMAs, if you couple that with Heikin-Ashi, that could be a very good point for you to take a short position. So long positions are where you see a bullish crossover on your EMAs and you see a green Heikin-Ashi bars. That generally will be a very good position for you to long the market. So that's how we can use crossovers together with Heikin-Ashi. So these are some examples of crossovers. So bearish crossovers against is where the shorter term time frame is moving below the longer term time frame. So just moving to trade examples, since if you combine all together, really if you just look at Heikin-Ashi itself, sometimes it's very difficult for us to pinpoint the exact entry and exit. So it's best if we can incorporate the moving average crossovers as well. So what we have here is that if you just look at it, we have green Heikin-Ashi bars, and this looks like it's going to be a bullish crossover on the EMAs. That could be a very good position for you to take a long position in the market. Now, the reason I put ATR at the bottom panel of the chart, which is signify the average true range indicator, the reason being is because whichever time frame they're using or looking at, every time when you put in a particular trade position, it's good that you make sure that you have a stop loss in place. So a way to put stop loss measurement is to use the ATR value. So at this example, the ATR value is at 3 points. So if you're just looking at to long at Soybean at 13.13, so normally your stop loss will be 2-to-1 ratio. So your stop loss will be placed at 13.10 with a target profit at 13.19. So that's how we use ATR value as a way for you to measure your risk and reward ratio. Again, the reward to risk ratio is up to individual. In fact, to say most examples I use is 2 to 1. Again, I think that depends on individual as well. So another trade example, we can really see here, we have a green Heiken SG bars, and we have a bullish crossover on the EMAs. And again, the ADX is climbing above 20. So that tells you that the trend is probably in place. So looks likely the uptrend that we are seeing in this particular time frame, it looks likely it's going to be starting soon. So ADX itself is a very good indication as to whether the trend will likely to see some strength. As long as the ADX is climbing above 20, that tells you the strength in the trend itself. If the ADX value stays at 20 itself, usually that tells you generally the market is on the ranging market. Apologies that it's not ATR. In this example, it's ADX indicator. So ATR is mainly used for your risk management purpose. Yeah. So again, I think another example on using ATR. So you can clearly see here we have a red Heiken SG bars, bearish crossover on your EMAs. It'll be a good position for you to take a short position. So what we do here is that the ATR value is 9. So you can short at 1700. Your target profit level is 1682, which is about 18 points, and the stop loss level is 1709. So that's how we use the reward to risk ratio by using ATR value as a way to manage your risk. So keep in mind, as long as the market gets volatile, your ATR value will increase substantially. So that's where you need to adjust your stop loss, a wider stop loss in a sense. So that's in a way, whenever market gets more volatile, be prepared to manage your risk proportionally as well. So going to the end, as I mentioned earlier part in my slides, whenever we trade grains, it's always good to look at seasonality. I did mention June to October period is usually quite a weak period for soybean. So what I have here is just the 24 years price seasonality chart for soybean. If you just look at it, if you compare January to December, in fact, I think August is actually quite a weak period for soybean. So we are just only the first week into August, so we still have 3 weeks remaining. Let's see whether the historical will repeat itself, whether August is indeed a weak month or not. But generally, I think over the past 24 years, we can clearly see that around July to September is usually quite a weak period for soybean. Now, if you are someone that is trading the space, you should be quite careful of taking a long position during this particular point in time, based on seasonality. Again, you can't. These are all historical data. You can't really use it to to project into the future. Again, I think there's a lot of caveat into it. But it's still quite a good tool for you as a good guide, especially when it comes to particular strong periods or weak periods of the year. Now, I just want to touch a little bit on the market structure. Market structure hereby refers to, if you just look at the different months that is listed on CME exchange and all the different contract months itself, and just look at the prices, you can clearly see that the September contract and the November contract, there's a big price difference in between. This tells you is that, and September contract is actually trading at the higher prices compared to November contract. This usually signifies that the market is clearly in a backwardation market. Don't mind the lingo. What it means is that we are seeing there's a lot of tightness in the spot market. But as we head into the further months out, really we're going to see supply coming in. And when you have such a big price difference, that tells you generally the supply situation in the current month is actually very serious. So I think it goes to tell you, even though we are seeing a lot of negativity when it comes to the fundamental aspect of the market, but what is happening on the ground is that there's a lot of tightness they're still seeing in the market. Whether this is due to logistical issue, whether this is due to certain demand that's coming in, especially with China, certain cities are coming out of lockdown. I think that goes to show. But it's important for us to understand the structure in a way that once this structure starts to change, imagine if the current months are starting to be more pricing cheaper compared to far months, that usually tells you generally the trend has started to change. So it's worth to pay attention to. especially when it comes to structure. Although it can get quite complicated, but it's important to take note is that whether the market is in a backwardation or contango market, it's important for us to look at what is the current prices. As long as current prices is trading higher compared to the further months, it tells you generally the market is actually quite tight. Now, when it comes to soybean contract, I think CME soybean contract itself provides you a very good benchmark. In fact, I think around the world, people will look into the CME contract as a global price benchmark for soybean. So if you just look at volume and open interest itself, it's actually very liquid. They're looking at about 200,000 contracts on average, for a soybean contract. So I think there's a lot of liquidity that's in the market. In fact, even the open interest is easily on above 500,000 on a daily basis. So it goes to tell you that there's a lot of liquidity, that in the market, and there's no worry about having your bid and offer not being done at a particular point in time. So this is a CME soybean contract. I'm not going to go too detailed on it. You can always refer to Phillip colleagues. They're more than happy to always share with you what are the latest promotion or what are the latest contract margins, to trade the soybean contract. So I think I'm going to end it here. I'm just going to take any questions that you may have. I'm just going to pause for a minute for any questions that you may have. Just type in the chat question box, and I'll probably will address it soon.
Hey, members of the audience, I noticed that some of you gave feedback that you can't hear the webinar or some portions repeated itself. Not to worry, this webinar is recorded and we will share a link to the video recording after the webinar, most likely tomorrow. So do look out for a follow-up email. The link will be in there. All right, David, just a heads up to you. Most of the operational questions have addressed it, so you can pick up the questions starting from Hong Keng Ong at 7:19 p.m.
Okay, sure. Yep. Thanks, Sri, for answering the rest of the other questions that the audience may have. So I'm just going to start with the first question. What's the role of China in the grain production? If China is a net exporter, will the zero-case scenario of COVID in China affect the price of grain? Wow. Yeah, that's a very good question. Thank you for the question. What's the role of China in grain production? China, when it comes to grain production, it's actually a very limited role. In fact, if you look at it, pretty much they are importing a lot of other major grains from a lot of other countries. Palm oil from Malaysia, major grains, corn and soybean from South America and US. So really, I think China is a very big consumer. So although they do produce certain amount of grain, but that is not sufficient to meet their domestic demand. So obviously they are a net importer. Now, when it comes to the zero-case COVID scenario, now this is very tricky. If China continue to maintain a zero COVID policy, it's going to have a big impact. Whenever any cities record any one case of COVID in a particular city, they pretty much lock down the whole city. This is going to have a lot of logistical nightmare. In fact, it's going to affect a lot of demand coming from, retail sectors. So, this generally is as long as they're going to maintain that kind of policy, it's going to have a big impact going forward. So hopefully, I think cases are starting to die down, and I think things are starting to go back to normal. Hopefully, you start to see a bit of traction when it comes to demand for soybean from China. Okay, so next question is how is the phase 1 trade agreement between China and USA? Is China already completed the buying on soybean from USA under those agreements? Now, if you just look at the phase 1 China and US agreement that signed back in during the Trump era, if you just look at it, I think the progress was about, the latest figures is about 65 to 70% done. There's still a bit of room. And I think given that the Biden administration came into the picture, I think those figures are generally slightly on the lower end. I don't have the exact numbers, but because I think there's a lot of, the tension between US and China continue to persist. And I think with South American trying to rush into that space and to rush to fulfill China demand, I think that's going to have an impact from US side as well. So really, I think going forward, when it comes to the China-US agreement as to as to the soybean buying agreement, I think they probably will not complete it in any phase. In fact, I think those numbers is actually quite far off, and I think that's because the tension between US and China continue to be quite escalated at this point in time. So next question is, what's the meaning of spread between soybean oil and palm oil? Okay, now whenever you trade palm oil, there's always a relative byproduct, which is the soybean oil. And if you just track these two products separately, you notice that the prices of these two products tend to move quite they're quite correlated in certain ways. Now soybean oil is obviously a byproduct of soybean. You crush the soybean, you get meal and the oil. Palm oil is obviously coming from oil palm tree. So both of these are vegetable oil. And because the production of soybean oil is relatively higher compared to palm, so therefore they can command a premium. And if you just look at the spread between the soybean oil and palm oil, it has been trading at a premium. The average premium between the soybean oil and palm oil is about $150 per metric ton. But that scenario changes last year when it went to as high as 600. In fact, right now the spread is also reaching as close as $500 to $600 per metric ton. So I think this is something to watch out for. And if you are someone that's trading the palm oil space, it's worth to look at soybean oil because it does share a bit of relationship when it comes to the palm oil market as well. Keep in mind, both are vegetable oil market, so therefore they share a bit of relevancy and similarities. Okay, another question regards to the soybean and palm oil. The widening spread of soybean oil and palm oil currently, is there. So what is the strategy that we can use? Now, I'm not advocating, any of the audience to really look at, getting the information or extracting information from the spread itself. But what the spread tells you is that, whenever you have a high spread scenario where you see the soybean oil trading at a much higher price compared to palm if you compare it on a similar basis, it goes to tell you that pretty much there's a bit of upside when it comes to palm oil as compared to the soybean oil perspective. Because eventually, if you are someone that's looking at the spread itself will mean revert given time. So again, it's a matter of time. Now, it's not to say that the historical high is $600, it will stop at $600. It may, it may go even higher than that, given the fundamentals of these two particular commodities are different. But again, I think given time, the spread itself will not. Once situations normalize, it will eventually be, reverting back to its original average is about $150. But the question is a matter of when. So I think that's more important. So I'm not advocating for anyone to be trading based on that information, but really to use the information to probably create a view or to aid you in your trading of a particular product that you're looking at. Okay, there's one question here. What do you mean when you say market is trading very tight? It determines the volume or the resistance level, or what does this mean? Okay, when I refer to a market is trading very tight, so I'm not sure whether the question is referring to technicals of the market. When I'm referring to markets, technical markets are trading very tight, prices are trading very tight. If that regards, it means that based on chart perspective, prices are trading very tight. Normally, it's trading at a very tight range. If we talk about fundamentals of the market is trading very tight, that tells you generally the market is short in supply, stock levels are low, and that's usually a tight market scenario. So when you look at this one, I was just talking about contango and backwardation market. Right now we are in a backwardation market. You can clearly see from the market structure itself. So generally this market is considered a very tight market. A tight market, which means that the supply is low. At this point in time, the stock levels are low. Demand is quite strong. So therefore, eventually the market will have to adjust. So the market scenario seems to be quite tight. So I'm not sure which perspective you're looking at, but when I refer to tight market, So that's more to the fundamental view, and another one, the technical side, is more to the range trading. So I'm just going to take one more last question. How are that, Sri? Are we good in time?
Yeah, go ahead, David. Go ahead.
Okay. Yep. Okay. So this last question is how to relate risk management with higher ATR value which show volatility. Oh, okay. I think this question relates to one of the slides we have shown earlier. Okay. Now ATR value stands for average true range. So true range, I'm not going to go too much on the calculation. You can obviously go and Google it. True range always refers to basically the range of the particular, the trading range of the particular product. So if you have high ATR value, that tells you generally the market is trading quite volatile. If you have low ATR value, that tells you generally the market is actually quite not volatile as such. So the reason I use ATR value as a way to manage risk is because, say for example, with every entry that you enter, you need to make sure that you put a stop loss in place. There's a lot of ways to put stop loss. You can put an arbitrary number, you can put a percentage ratio. There's so many ways that you can do. But one of the ways that I always advocate is to use an ATR value, because when market gets a bit more volatile, if you don't adjust your risk accordingly or your stop loss accordingly, you tend to get stopped out quite frequently. So that's where I say when you have a high ATR value, you have to be prepared for giving a bigger buffer when managing a risk, because when market gets a bit more volatile, that's where your ATR value will increase. That's where your stop loss will also be higher. So in a way, you don't get stopped out quite frequently. So that's why the reason I use ATR value as a way to manage your risk. So hopefully I can, I still see some other questions. Hopefully I can answer those questions offline. Sri, you want to add anything?
All right. Thank you so much, David, for the insights and the wonderful views.
Yep. Thank you.
And thank you for being a wonderful audience and staying through right till the end. If you have any more questions, you can send them in the survey form right after this webinar, and we'll reach out to David and get his views on it. Once again, thank you for being a wonderful audience, and do look out for our upcoming webinars. See you then. Meanwhile, take care, be safe, and all the best with your trading.